Welcome, welcome, welcome. Uh-oh. I can't hear myself. That's not good. Let's try that again. Uh-oh. Can you guys hear me okay? Because I cannot hear myself, which actually isn't a bad thing at all, if I'm being honest. But I will double check anyway to make sure the audio is going in and through. Okay, well, today's show is going to be an interesting show. I've had all sorts of technical gremlins and glitches today. Let's see if I can fix this here. OBS, hide OBS, we're good. Roadcaster is launching. Okay, so we technically should be working, but something tells me that the audio coming off of my end and back to me is not working, which is a relatively simple fix later on. All right, the market is starting off in its usual cataclysmic way. It is a start of Q2, and we are expecting to see earnings season kick off. A lot of the same rhetoric around AI and social media has been present and doing exactly the same thing that it was going into last quarter, although we've seen a shift from the vibe coding narrative into now a shift of the agentic management era. I don't know if any of it's really true or any of it's not, but what I can tell you is the Fed is certainly starting to flash some tones of higher for longer narrative. You'll see that link in the show notes. That was out there a little bit earlier today. Today, we have the market at, that's the stock chart. Let's take a look at the mixed day. We have no clear trend on the day. The U.S. stock market is sitting at a pretty mellow mixed day, almost closer to the tech-led space, but not really their position. This puts us at kind of an ambivalent kind of mini start on the actual day. And I think a lot of this is driven by the fact that people don't really understand what's going on in the zeitgeist. Are we going to have conclusions for things like geopolitical conflict in the Middle East? It doesn't sound like we're going to anytime soon. Dow Industrials, S&P, Nasdaq, Russell, and QQQ are all incrementally up, but we're not seeing a lot of heavy volume. Meanwhile, the synthetic volatility, our proxy for the VIX, seems to be in the edge of that normal to calm range. I would say this is probably pretty indicative of where the markets are and pretty simple to understand. There just hasn't been a whole lot going on. If we do see increases in things like the volatility in the Middle East or a lack of some type of capitulation there, then you're going to see that creep up. If you want a proxy for what CNBC has the VIX at, you've got the VIX at 15.76, which is far below what I would call our traditional fear metric. Keep in mind, 20 and above, afraid. Anything below 20, and you're kind of meh. And yeah, I would say that you're pretty not scared on the day, although you are seeing some things that are interesting in the Bitcoin space. I haven't checked the narrative on Bitcoin yet today on the XAI narrative, which we'll share here in a little bit. But you're also seeing that Michael Saylor sold down a pretty healthy position from MicroStrategies, which saw this drop below 62,000, far and away not the lowest it's been recently, around 58, 59,000. But certainly you saw some pressure. I think people are buying now on the hopes that that dip is a floor. My underlying consternation with Michael Saylor selling Bitcoin, and I might as well just do this now. If I go over to X, you can go to my profile and see the post from this morning on there, just on this topic alone. MicroStrategy sold, there we go, perfect. MicroStrategy sold about 216 million worth of Bitcoin, not to buy more, not to rebalance, to fund dividends. That's a problem, kids. And the entire MSTR thesis was built on one idea. Bitcoin is a treasury asset that never leaves. The moment you sell it to service equity holders, like we're seeing here at Michael Saylor's activity, you're not a Bitcoin company anymore. You're basically just a leveraged fund, and an over-leveraged fund at that. This is the chart of Bitcoin's price in the not too distant past. This is from July 25 to now, so it's a 1-year chart. You can see it's a pretty notable decline there. I'm sure the people that are big advocates are going to say that's a start to go back up. I don't know that that's going to be the case. I think with Anthropic and OpenAI's IPO on the horizon, you're going to see a lot of this stuff be sold off and reallocated into those particular assets, particularly in light of how SpaceX has performed. Despite the fact they're down post-IPO, I would say it's a pretty normal contextual position for a company like SpaceX to be in, so that doesn't scare me a great deal. But what I will tell you is you're probably going to see this go down even further as people try to liquidate and create more money they have in their pocket. The Fed's balance sheet continues to be tense, although it's not as tense as it has been in recent months and weeks, largely because the bank borrowings overnight have seemed to have gone down a little tiny bit. But, it is what it is. Home affordability continues to be stretched. I really wish they had better data on this. I'm thinking about switching from the Fred data, which is the source that we get a lot of this information from. But because it's so outdated, that I was thinking about, for like your average 30-year mortgage rate, for example, right? We know that number is higher today than this suggests, but it's also Q1 2026, and here we are at the start of July. So yeah, I don't really know if that's indicative of the rate. And I don't think that's probably fair. And there you go, 6.43% for 30-year mortgage rates. So you can see our AI is now plugged in and doing all the sexy things, which I got to tell you, it took a lot of work to get to a point where Atlas is not only pushing this data here for us, but also pushing this data here. I'm very happy with the results and some of the data pieces that come up. If there's anything that you guys see that you think would make this whole system better, by all means, please let me know. I'm kind of so close to the design elements here that I don't really know what could and would not be better at this particular juncture, just because there's so many things that this can do that I haven't really thought through. Let me check and see who's here on the socials. Welcome, everybody. What up, Big Vic? Watching on Instagram today. I appreciate you. Had a bunch of, IT glitches this morning. I'm still lacking audio in my earpieces, so let me know if you can hear. I have a feeling you guys can hear just fine because I can see the triggers on my end of thing. I think it's just my Rodecaster not processing the audio, which is a pretty simple fix on my end of things. Hope everybody had a good 4th of July. So let's get into the sectors. As you know, we like to do the home building sector. Rate sensitive demand is down on the day. That doesn't really surprise anybody, I think, given that some of the conversation we were having going into the holiday weekend about how the rate sensitive demand here was going to continue to be impacted by rising mortgage rates. When I checked this morning, the bond market, the 10-year was up. And you can kind of see here, we are sitting on a 4.483% 10-year. So we are, in fact, sitting at a rate upward pressure environment in the single-family home builder space, which is in part why you see the sectors incrementally down today. I don't think this is indicative of long-term strain. I think this is all foreseeable and something that we talked about on prior shows. So no one who watches this show regularly is surprised by any of that. The banks are all incrementally up on the day. I don't think there's any credit conditions that are materially affecting or concerning them. If anything, people are, pretty happy with bank performance. I continue to think the banking sector, particularly the small balance community regional banks, are going to see M&A activity. JP Morgan Chase, Bank of America, Wells Fargo, Goldman Sachs, and Citigroup will largely be some of the people who will pick up some of these smaller community regional institutions, but it'll be those mid-tier, like Huntington Bank shares size banks that are your quote super regionals that are going to swoop in and buy, I think, more of the community regionals as you start to see a lot of the CEOs exit and a lot of people with some more tenured seating say it's time to sell or time to grow. And a lot of them that are getting a little older are going to want to sell. The commercial real estate refinancing risk space continues to show a little bit of pain points here. I think there is some longevity here. I do think the real estate investment trust market is going to do well. And I also think this sector is particularly undervalued as you see people convert over to less of an office space and more of a workforce, multifamily workforce housing outside of the Sun Belt regions. But I think this is an underperformer for right now. I think you're going to start to see it perform better as people start to shift from the stock market. Now, this is one of those conversations where we probably owe each other an intellectual honesty here with this. The stock market is an enigma, right? People think that you're going to see numbers hit all-time highs again. I don't know if that's true or not true. What I can tell you is we've seen an unbelievable run in the stock market, and it has so far outperformed real estate for so long that I think it's worthwhile to note that I think that there is a correction on the horizon. Now, I don't know if that's next year, 5 years, 10 years, but at some point in time, there inevitably will be a correction. The correction in the market today has more downward path or trajectory to go than the real estate market would. Full disclosure, I am a real estate investor by trade. It's my background. It's what I love to do. The stock market stuff is all anecdotal to that because the macro information helps make decisions on the real estate side. That all being said, I think the place to put your money for the next couple of years is going to be in real estate, particularly if we see affordability improve as that happens. So let's say we had, after 20 years of artificial interest rate deflation, we start to see home affordability improve. You start to see a rate environment which ultimately gets inflation under control. And again, this is a years in the making process here. I am still a believer in real estate. I continue to think that the asset that's tangible and tactile will continue to have value appreciation over time. Will it have outsized gains like the stock market over the last several years? Probably not. But do I think that's the place that you should park your money as affordability improves? 100%. And that's going to be very different to a lot of people watching onto the show because a lot of people watch this show on X, and if you're coming from places like Threads and LinkedIn and Instagram, there's a very, very, very heavy stock presence there. I get it. I'm not judging anybody for that. I'm just telling you that that's my personal philosophy. The mega caps, let's talk a little bit about them in the sectors. You got Apple, Microsoft, Nvidia, Amazon, and Alphabet all doing pretty well in the day. Microsoft laid some people off. Their stock price is taking a hit as a result of that layoff notification. If you've been watching the show, you know that I have been critical of Microsoft, and I think it's starting to show up in their share price a little bit. This is not to knock Microsoft so much on what they're doing. It's more of me getting concerned and frustrated with their lack of innovation over the course of the last several years. I say this because Microsoft is, let's go back a little bit. There's a clip making the rounds on the internet. I'll see if I can find it, where basically Microsoft's function when they started to come up was to put a PC on everybody's desk. And putting a PC on everybody's desk, I figured out why I couldn't hear. It's been one of those days where I can't seem to get anything right. So let's see here. Oh, look, guess what? I can hear. That's hilarious. I really got to pay more attention. Microsoft's goal when they started coming to fruition was to put PCs out. And the PCs were not because they wanted everybody to have a computer and buy hardware for them. They knew the real money was in software. So the ecosystem in the business environment that we see today, Excel, PowerPoint, Word, was all a byproduct of them selling machines to us and then us putting their software on the machines. The software is where they made their real money. It was a sunken one-time cost up front plus whatever rollouts you put down. And Microsoft blew up. They changed the way the world worked. You had a PC on everybody's desks. And to this day, a lot of the way we work in American popular culture is a result of Microsoft selling all this hardware to get all this software out there. And we still use this software to this day. But some point in time, they got so large that they did not innovate. They stopped innovating. That's why Microsoft Teams sucks relative to some other tools that are on the market. That's why Slack is out there and all these other products that are more innovative and more functional. Now, the problem for most of us as working Americans is unless you're on your own, working in your own environment and can pick your own product, you're locked into that. And because they bundle all these products and everybody uses Microsoft Word as kind of their baseline word processing software, you get locked in. But Microsoft has not innovated. They have not done anything cool. They have not done anything new. And because of that, their technology, as it is still, number one, utilized by the masses because companies lock you into it. But more importantly, number two, it's not loved by the masses anymore. And now you're starting to see the pain points of Microsoft come to fruition. This was on my X earlier today. I shared it. I know that it's small. I'm playing with screen size and resolutions here. But I have screamed it from the hills. Microsoft has failed to innovate. They got too big to be nimble and have let smaller companies steal market share with superior products, despite owning a colossal ecosystem that companies lock people into. And they do. Your company is going to say, you can only use Microsoft products. You can only use Microsoft Copilot. Let's be honest, Copilot sucks. Thank God you can now use Anthropic in the software choices that you have, if your company allows it. But therein lies like a bigger macro problem. When is Microsoft going to get to the point? You're now laying people off, okay? We now know the pain point is real. You're going to have to figure this out. Shame on you, Microsoft. Let's go. Come on, be innovative. Meanwhile, let's go to the consumer sector. You know how much I like to talk about how this is going well. Today ain't that day. And this is why you see a mixed day in the market. I'm a big fan of Target. I think their stock price continues to underperform relative to Walmart and some other places. I think their new CEO needs a little bit more runway, but I think Target stock's going to bounce off a little bit and pick up from this 3% decline that you're seeing here today. But over the last several months, I think Target's done pretty well. As a matter of fact, let's take a look at Target stock price while we're here. TGT. I'll generate a chart. Let's look at the last 1 year on Target stock. There we go. So 1 year, it's down 3% on the day, 126. I mean, it's not looking like the sexiest chart in the world when you look at that 1 year figure. Let's take a look at year to date, which is only really a 6-month chart. There you go. So year to date, not so bad. And that, I mean, if you think about kind of the context and when I started talking about Target, this is around the time, right about there, where I started telling you that I have pretty lofty aspirations for where this company is going to wind up. So it's good to see that at least on that timing horizon, I wasn't god awfully bad. But you know, I think Target's going to do well. I think that the problem for them is you're looking at somebody like Amazon and Amazon. And I think Amazon's going to really outperform. That's about Amazon stock. What am I doing here? All right, let's clear this off real quick and let's get back into the sectors. All right, I think Amazon stock is an outlier because they control a narrative market. I think Walmart has really tried to replicate what Amazon has done. I think Target went a different path. I think that using their data in the way they're planning to in the future is probably going to go very well. But again, consumer discretionary spending will pick up as you start to see more stress in the economy. One of the things from a stress perspective that I shared just recently on X was about consumer discretionary spending actually having material impacts, like I've been kind of forewarning for a great period of time. Let's see if I can get a nice big chart here. Here we go. Perfect. All right, there's Amazon stock price for you, so you can see the dichotomy between Amazon and everybody else. This is an interesting chart. I got this from Bloomberg, and I've been really watching consumer discretionary spending as kind of what I would call foreshadowing to what could be recessionary trends, and it's been concerning me a great deal where the spending is and is not going. And I know that we've seen this K-shaped economy, and the top 1% spends almost up to 50% of what props up the economy at any point in time. But let's take a real detailed look at 4 sectors, according to Bloomberg. Fewer places to relax and socialize, U.S. establishments per 100,000 people. And for those of you who are older like me, this is probably going to cause you to think about some things. Jason, audio all good on LinkedIn. Thank you, Jason. I appreciate it. I finally figured out that I'm the moron. It wasn't the system. It was me just not plugging in my headphones because I just needed more of a view here. Vic, quick question. Do you think that AI is becoming another type of asset bubbles? Yes, I do. I do think that. I will provide some more insight on that, specifically given that AI replaced certain jobs across a few sectors. I would say, before I get into this, I'll actually answer that question. On the AI side of things, AI was thought to be this hyper productivity, kind of boon. but it was done so without the human element there in the original pitches, right? And everybody was like, you got to use AI, you got to be more efficient. Now everyone's talking about how we're overseeing agentic AI. I've spent a lot more time than most people diving into this. I've built our own agentic AI. One of the things I posted about recently was I just upgraded from Sonnet 4.6 to Sonnet 5.0. But in doing that, there were some technicalities that made it a bad change. I actually transitioned back. Everything you're seeing pushed here is done vis-a-vis Sonnet 4.6. So when I was using Sonnet 4.6, the previous model, the non-Mythos level model, I was spending about $2 a day, okay? $2 a day, all the same work. I upgraded to 5.0, which is on a discount introductory pricing plan, and it was supposed to be cheaper for the first 3 months, but what they don't tell you is that all of the data, there's input data and output data, right? Upload and download, if you will. These are in the form of tokens. The token usage in 5.0, despite the fact the model is cheaper for that introductory period, was actually increased for most tasks about 35%. And because of that, this model thinks more because it's a more robust model, and it costs more on a relative percentage basis. So I went from $2 a day to approximately $30 a day for the same relative compute output. Nothing you're seeing here is bad. Is Fable and Sonnet and all these models fantastic? Yes, they are, but they're hyper expensive, which is part of the reason you're seeing people like Meta go, whoa, 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 you guys are spending too much. And I have friends at places like Amazon who tell me that their usage is unlimited on some of these models, but they'll be the first people to tell you that they're not being thoughtful about cost. They're using the best model, but the best model isn't always the best choice. I'll give you a great example. The response time on Sonnet 4.6, which is a perfectly viable model, was really quick. It was efficient. I could message my 4.6 based, main session, and I would get a response back pretty quickly. No big deal. I would be back and forth in the gateway. With 5, I had to message, I'd wait, hang out a little bit, grab a coffee. It was slower because it was thinking more. It was burning more tokens up, burning more tokens down. And that's why you saw such a huge cost difference. And the output wasn't really that much better. So what I think is going to happen here with AI is that we went from this, everybody's got to, use out, these models, these frontier models. Then it was, oh, everybody's got to have an agent. And then it was like, oh, everybody's going to lose their jobs. And now I think everybody's going to be, there's going to be less people being hired, but you still have the human element there. You still have to oversee a lot of these functions. And I think that the cost benefit that a lot of companies thought they were going to get is being severely outweighed by greed. So when API fees become the new roaming charges and those go away, you might have an opportunity for these frontier models to cause job losses because companies will say, okay, these Mythos level models, they might be able to to remove an employee from the process. Well, if a person overseeing a model is spending $50,000 on just API calls with the legacy models, and these models have all gone up in price, notably, let's just say that same $50,000 in API spend goes to, let's be conservative here, $75,000 in API spend, and this is a non-Mythos level model. This is not Fable. This is not Mythos. This is the lower tier models, and those models are even more expensive, and those weren't even out when these numbers came about. I would say this number could easily be $100,000 in API spend for just one function. So now you're talking about, is it really viable to replace an employee if that's how much you got to spend on just API calls? Not to mention the whole Alex Karp debacle, where Alex Karp was saying, okay, do you really want, as Amazon, Anthropic or OpenAI to be able to see inside of your organization because they're seeing all the requests come from your engineers at any point in time? And the answer is probably no, which is why they sell their ontology layer. So again, I think that it's overblown. I think that there is a bubble here. Long, convoluted answer. I apologize. I do think that the utility that people are talking about with these products are severely outweighed by the cost to run them right now. And I don't think there's a near-term efficiency play here that's going to solve that because OpenAI and Anthropic aren't making money. They're going to have to find a way to make money outside of the frontier models that it's going to be cost efficient. They're going to have to find cheaper power, cheaper compute. And I don't think we're anywhere near there yet to justify getting rid of the humans completely and putting in AI. I think what's going to be required of us is just more output as a human who's leveraging this as a tool the same way you would Microsoft Word vis-a-vis a typewriter, for example, right? You would expect more work out of somebody using Microsoft Word than you would out of somebody with a typewriter, even though there's people who are good with typewriters. So long, convoluted answer, but let's get back to the other conversation I was having. So this is bars, nightclubs, bowling alleys, and marinas and movie theaters, okay? So These are four of the most common American places. We all grew up, if you're, if you were over the age of 21, going to a lot of these places. And if you're under it, you went to at least the bowling alleys and the movie theaters. To me, the movie experience was a huge part of my upbringing. I love movies, still love trying to bring you cinematic content. That's why the podcast looks kind of more movie-like than newsroom-like. That was intentional. That's because I love movies. That being said, this is kind of crazy. Bars and clubs per capita are down more than 60% since the late 1970s, right? So that's these right here. And that's also, you think about what you're seeing on social media. You're seeing people go to run clubs instead of bars. You're seeing people go to coffee shops with a DJ instead of going out to nightclubs. You're seeing a whole health and longevity revitalization, which goes along with way less drinking. Not to mention the fact that some of these places are charging 50, 60 bucks for a drink in some cases now, which is also insanity. Bowling alleys are also seeing the pain too. Since 2001, 1/5 of movie theaters have closed. 20% of movie theaters have closed since 2001. That's crazy. That trend does not bode well, by the way. Over the last 20 years, America has lost roughly 2,000 golf courses and 7,000 bars and nightclubs. And we're seeing golf go from the courses into more pedestrian type things like Top Golf and things of that nature, which are probably a little more engaging and less traditional in the sense. But even then, you had golf that was dying out and that had been revitalized with a little bit of that new entry point. I think there's still a whole lot of people who are getting into golf for the first time, but you're seeing a meaningful change there. 2,000 golf courses, 7,000 bars and nightclubs. Bars and nightclubs have always had some pretty high churn rates, but that's still a pretty high number relatively. You used to see them stick around in places like Los Angeles or Chicago and Miami for a prolonged period of time, but really now the top tier ones do, and those lower tier ones just kind of cycle out pretty quickly now. So live music, top tour averages $134 last year, up 42% from just 2019. Keep in mind, 2019 till now, you've also seen about a 33% erosion in the dollar. So really, when you take that, and, you look at about 33% of that, that's more like a $200 in 2019 dollars to now approximately. So it's a big difference, maybe a little less than 200, but still get the point. So Americans are staying at home more now than ever, so much so that nearly 80% now see friends and family fewer than 3 times per week. And I can attest to that. I think that's a real thing. I think a lot of people are staying at home because not only because it's cheaper, we're living in a world where people have 80-inch, 100-inch televisions at home, right? And if you're living in a place where that is an option for you and you get this full, movie theater experience plus with streaming media, you just go out less. And if you can make cocktails at home for way less money than the $50 per drink outside. Now, where this does get interesting, and this is also parlays into birth rates and people having children and people meeting partners and that all happening in a digital sphere, which is not happening quite in the real world that it once did. So this is having all sorts of impacts to humanity that I think are really unquantified at this point in time. We can look at the numbers here from a math perspective and go, oh my God, that's shocking. But there's also a human toll in an element here, which is kind of wild and really, really unanswered. So I apologize, Vic, long answer for you, but I thought it was worthwhile to talk about Caterpillar, Deere, General Electric, Union Pacific, and 3M. I do want to spend a little bit of time talking about Intel because we're going to see that on the XAI chart. Intel stock price is surging again today, as it should be known. The government took a stake in it. Trump literally bought some of Intel and disclosed that on some of his public disclosures. So their stock price is actually lifting up a little bit today. Energy is somewhat indifferent. Exxon, Chevron, Conoco, Schlumberger, EOG Resources. Kind of a mixed day. Schlumberger's always been that one, or Schlumberger if you want to be technical. That's always been a little bit of an outlier in that regard, so that doesn't surprise me to see them up when everybody else is down. Let's see here, CNBC.com. I want to take a look at oil prices real quick. Oil, there we go. There's Intel's price for you. 122 up 1.54% in the day. Actually, I'm going to take a look at Intel's chart, and let's take a look and see what Intel has done over the course of... This was not a company that was doing very well, as you all probably know. INTC, let's generate, what do you think, a 6-month chart? That seems like an appropriate run here. There you go. Wow, yeah, see? Look at that. Government takes a stake in Intel. Okay, that's 6 months. Let's look at 1 year. I guarantee this is going to be interesting. Government takes a stake in Intel, and in that stake in Intel, you get a curve that looks like that, particularly with the president saying what he said today. We'll probably see that on the XAI social narrative charts here where you see that number pop up. That is wild, man. Crude oil, WTI commodity. Thank you, Atlas. Look at you. 68.36 down about 45, one half of 1 point or so, 45 basis points down. See, and that's the power of Atlas. Is like I don't have somebody here real producing this. So the fact that he can hear what I want to talk to you guys about and pull that up, man, that's so good. Let's finish up the sectors, get into XAI real quick. You know how much I love that. It's my favorite part of the show. Defensive stock positions. We're not in a very defensive position today, so these are not going to do very well. Procter & Gamble, Coca-Cola, Johnson & Johnson, Xera, and Duke Energy all kind of down on the day. And that's because you're in a mixed day. Tech-led is off the table. We're kind of in that space. And because we're in that space right now and the status of the market is what it is today, we're incrementally positive, no clear trend, you're going to wind up seeing the defensive stocks do kind of meh. Once the market moves to a defensive position, you're going to see both consumer and those defensive stocks rise as a result of it. And until we get any kind of clear picture, it's going to be that. Now, XAI, kids, the more and more we do this, the more and more I love it. Semiconductor rally, S&P. Chip stocks earning as new market leaders, bullish on S&P 500, target of 8,000. 8 of top 10 performer stocks are semiconductors in the Mag 7. Yeah, that's real, and that's a crazy thing to think about. While semiconductor enthusiasm is high, the revenge trade narrative and concentration risk suggest potential crowding. Monitor for profit taking in 93% S&P. Yeah, Sean, did you apologize that you were late, dude? Oh man. Not only should you not apologize you were late, we started late, and oh, state SPY. There you go. Look, see, stocks edge higher as market see. This is the stuff that if I had somebody back here producing, pushing that stuff on screen and throwing stuff on, like, the teleprompter over there, it'd be different. But the fact that we got that going is pretty cool. And with the logos too in the bar, man, we getting fancy over here. And I appreciate you, Jason, on the audio on LinkedIn. It really means a lot to me that somebody out there is checking. Unfortunately, I'm not the smartest tool in the shed some days when it comes to what my own assets are doing, but we got it worked out. All right, let's take a look at the second topic here. Energy sector, massive outflows, which is part of the reason why we saw on the sector chart here earlier. Energy funds posted 3.2 billion outflows in the week ending of July 1st. This to me, I don't have to read XAI here on this. This to me is because they're looking at what's going on in the geopolitical conflict, and they're saying, okay, we've seen this go about as high as it's going to go near term, long term. We're going to have to figure out where to redeploy that capital, but prices are going to go down here as oil costs get cheaper. So I think that's just where the money's going here. Contrarian opportunity, historic outflows often mark capitulation bottoms in energy commodities, which I could argue we're close to when you see WTI crude at around 68.49. I don't know how much lower you're going to see that. I mean, I guess you could argue that Venezuelan oil coming in would maybe drop that even lower, but I think you are seeing capitulation. I think this is the floor, so I think this is a buying opportunity if you're looking to see that creep back up. And let's also not forget that geopolitical conflict has yet to be fully resolved. It's just not top of mind for anybody because a lot of the social narrative just gets exhausted over this continual stigmatized narrative. Not saying that it's not an issue. Housing affordability dynamics, housing dynamics and affordability here. Wages outpacing home price growth within inventory at 1.55 million. Normal is allegedly 2 to 2.5 million. Something we should talk about here. The idea of how much inventory you have on the market and what is normal ranges a great deal depending on who you talk to and what their bias is. I'm not here to do that with you or anybody else. What I will say to you is supply is not the issue. If I go over to the home affordability chart here, while affordability remains to be stretched, this is not stretched by supply. I cannot say this more. Yes, long term, you need more supply. Near term, home prices and rates are the biggest dials you can turn to see changes now, immediately. Obviously, the more preferred one for most of us is to have higher wage growth and a lower cost of homes. That combination is not likely without some type of intervention or something meaningful happen. So supply is the longer duration fix there, but it is not the reason. Housing Starts latest release. So there you go. See, Atlas kicking ass and taking names today. Now, what would be really impactful if he explained Housing Starts' latest release compared to the previous Starts release so that we had some way to tell the difference, but that's just Atlas learning and growing here. Microsoft layoffs are also top of mind here on the trending analysis. Bay Area AI-related layoffs spiking suggest AI productivity gains, eliminating jobs faster than expected. I don't think that's it. Microsoft eliminating 4,800 jobs, 2.1% of the workforce. The Xbox division losing 1/5 of staff as tech giants cut. Again, they have not been innovative. Okay, they have not innovated, and because they have not innovated, you're seeing Microsoft get hit that way. It's not a huge thing. Trump has a meeting with Xi, President Xi of China. Trump expects to meet China Xi around September 24th in the U.S. Capital flowing out of Mag 7 into China as AI trade becomes due. September Xi meeting timing creates tactical opportunity in Chinese tech ADRs. I will say the Chinese models from an AI perspective, their frontier models, I guess I probably shouldn't call them frontier models, but their models are pretty damn good. And I think that this arrogance or bravado that we have about having the latest and greatest tech. There you go, Microsoft layoffs event monitoring. I gotta find a way to provide more data in the event monitoring. These came up last show too. But anyway, let's go to the X market and talk about it. How's everybody doing? Those of you who are watching out there. Let's see here. We got a couple on here on X, couple there. We got lots of people. Okay, all right. Let's take a look at X and see what's going on here in the markets, which I think are meaningful. I'm going to go to this screen here. This has been all over. Nicki Minaj is so hot. That's a strange. Trump, I've never liked short sellers because they're betting against this country. That's an interesting quote. Shall we listen to it? Let's listen. Let's see what we got here. That ought to be interesting.
Blackstone, BlackRock, they're all here. And think of it, I'm making them all geniuses. Every one of them is a genius. Is anybody doing poorly? If you are, I guess you have a couple of guys that went short. Those poor bastards, I mean, they're in big trouble. They're being wiped out, the short guys. I never like short guys because they're betting against the country, so that's okay. But earlier this morning, many of you joined me in the Oval Office for...
I mean, okay. Not sure how much of that really matters this particular juncture, but all right. Trump rings opening bell. Yeah, this happened this morning. Opening bell for the NYSE Nasdaq from the Oval Office. This was to celebrate his Trump accounts. This is the accounts for kids. I think this is great that you're putting $1,000 for kids into accounts. I don't know everything about it, but I think that's got a tremendous value upside for kids when they're born. I think the government should pay for more than just $1,000, and we should find some way to subsidize it. But that's great. That's it? No commentary? Really? All right, there you go. Geopolitical event. Yeah, we got to figure out these event monitors where I got to get more detail than that. Man, let's see. Monitor the situation. Situation explained. AI memory boom just created another trillionaire. SK Hinks is listing in the U.S. I don't even know what that is. Good for them. I like this show. These guys are good. CNN with a breakdown on Trump accounts. There we go. Let's talk about this. I looked into this a while back just for morbid curiosity. I didn't get as fully into it as I wanted to, but I think it's actually pretty decent.
Dan, when the free money machine is open and they're giving out $1,000, I think a lot of people want to know, how do I get that? So if you have a child that was born in 2025 or beyond, then you can get this Trump account as long as you're a U.S. citizen and you have a valid Social Security number for your kid. And actually, if you apply for a Social Security number, you can now apply for a Trump account at the same time with the same form. So what are the rules? How do you get this? Well, you can contribute $5,000 a year tax-free, tax-deductible investments in a low-cost index fund. That's like the S&P 500. Remember, the S&P 500 made 300% over the past 10 years. That could be a really good investment. But, even if you don't invest in it, it's a pretty good deal, and you can use it for things like college, obviously, because when you're 18, that's one of the places that you're going, but you may not. You might want to use it for your first home. You can even just keep it in your account and use it for retirement. If you use it for something that's not one of these, though, then you do get a 10% penalty, and you have to pay those taxes that I mentioned before. Now, if you do not contribute to this and you just keep $1,000, still with a 10% return, which is pretty conservative over the past 10 years, look at this. You can still walk away with $5,500 for college or something else like that. Now, that's not going to pay for college. If you do max out your contributions, you're talking about some really serious money, about $250,000 by the time your child is 18, assuming that 10% return. So the question is, how do I get this? Well, of course, it is IRS Form 4547. Why do you think that might be, Dana? And it is the trumpaccounts.gov, where you can sign up for all of this.
Huh. Well, again, I don't have a problem with it. I think it's a good idea. I didn't know that you could use it for just those three things, which, makes sense. The people who hate this concept are going to say, well, Chris, not only can we not afford $5,000 per year, but that amount of money in 18, 20 years, if you have from 2019 till now, 33% erosion of the dollar is worth considerably less than the inherent value to me now and the quality of life that I can give my kid now. But I would say you gotta cover your bases. This is probably a pretty cheap and economically viable way to put some money away. Even if you don't invest more than $1,000 to start, it's still $5,000 at some point in time. So I think you do it. I think everybody should do it if you qualify, but neither here nor there. I suppose it's just more of an opinion. The Dell, go out and buy some Dell. Yeah, let's take a look at Dell stock too while we're doing that. So before I play this clip, and I think this is going to be a noteworthy kind of conversation, did I make a mistake on saying that the government, Intel or Dell? We can't even tell anymore. They all sound alike. Let's take a look at the stock chart here on Dell. Dell Technologies. Wow, 1 year, 225% boost. Oof. Okay, well, let's hear about why. I know it's going to probably not surprise anybody, but we'll do it anyway. This is a 26-second long clip, so this should be pretty easy to play here. Maybe not. Huh. Well, that's weird. Easy fix.
They are truly incredible people. Go out and buy a Dell computer. He's not doing it for that. But I'll bet his business, Brad, has gotten even bigger. Michael and Susan Dell, they are truly incredible people. Go out and buy a Dell computer. He's not doing it for that.
Just seems like a bit of a conflict. That's all I'm saying. That's all I'm saying. Well, yeah, Trump saying, I don't think anyone understands how powerful Bitcoin is. This is an interesting one. Oh, man. I don't even want to play this because I know it's probably going to be a very bad idea. But we're going to do it anyway because I got to play all sides of the equation here. This is going to be a short one for sure.
But I will say this. To me, cryptos are very powerful. A lot of people are using it. Bitcoin. They're using it at levels that I don't think anybody understands really how powerful. And if we didn't do it, China would do it in a minute. But I will say this.
Yeah. Oh, gosh. Oh, gosh. This is interesting. Ex-Wall Street banker. In an industry that rewards psychopaths, and it's an industry that psychopaths thrive in, every junior analyst dreams of a lifestyle, six-figure bonuses, the glamour, and the prestige. But behind the closed doors is far more grotesque. As somebody who can attest to this firsthand, it's a 5-minute clip, and I am curious. I think we should check it out. Now, I will tell you, I've got horror stories from Wall Street, from private equity, some of which you guys have heard in the show. But I'm going to play this just to get a sense of what that looks like. Sean, my kids have Trump accounts. Good for you, Sean, as they should. My financial advisor opened them up for my 3 boys. You should do that 100%. My youngest got the free money. My other 2 had to put money in. There you go. I have accounts, not Trump accounts, but accounts that we invested in for Carter under the same kind of conceptualized idea. So the idea of doing that, I think, was valuable. I am super curious to see what this is about. I have not seen this, so this is all of us doing this for the first time. And I love these sets that have like the top lit and down, kind of real dark and gloomy, and I like Vice. So here we go.
I was an investment banker for 12 years, between 1996 and 2008. It's an incredibly secretive world. No one really seems to understand it. I thought it was about time someone explained what really happens.
Dramatic. I like it.
Investment banking covers a multitude of sins. In its very simplest form, It's about putting together people who want to invest money and people who want money invested in their companies. And we're in the middle, taking a huge slice. I had been to a decent university. I could also bullshit with the best of them. And that is an important aspect of any job in the city. The city is a place that rewards bullshit probably more than any other career. I couldn't believe the amount of money I was earning. So within about 4 years, I was earning 120 and my bonuses were getting up to 300. And then by the end of it, I was over 600. The money is ridiculous. I mean, the justification.
I would say for an investment banker, that's on the very low end of the spectrum of money that some of these guys are making. If you're kind of mediocre, that's probably how much you're making. But some of the higher end investment bankers are making multiples of that on just one transaction.
For the money have always been things like, oh, it's stressful. Well, this wasn't as stressful as a teacher's job. Oh, it's dangerous or risky. It's not as risky as being
dangerous and risky, not really for you. You're the advisor. You've got legal counsel and everybody else in the way. But is it stressful? 100% it's stressful. I mean, think about the context of these people are largely effectively commission driven. They have a base salary, but it's nothing relative to their lifestyle, and the lifestyle creep is real in the city and in surrounding areas. So yeah, stress is a huge part of it. That's also one of the expectations of the space is that you're constantly available and you will get pinged as an analyst nonstop. You could work for, Goldman Sachs. You could work for any investment banking group. You could work for Raymond James. You could work for Jefferies, Stifel, any of them, KBW, and you're going to be expected to answer the phone. You're going to be expected to take calls around the clock. It's not uncommon. I receive them, Saturdays, Sundays. I've had calls with private equity people till 3 o'clock in the morning, my time, and they were in New York, stayed up all night long to talk to me about deals that were looming and things that had to get done. So there's real stress there, and I don't know that you compare the same type of stress from one career to the next, but I would disagree with him. So I'm already skeptical of everything he's saying.
In the army, I always felt a little bit guilty about it. Like, why the hell are these people spending so much money on me when all I'm doing is pushing around bits of paper?
Okay.
It was a source of continual bafflement. Cocaine is the perfect drug for bankers because it is expensive, it's glamorous, it's something that can make you talk even more bullshit than you normally do. It gives your already inflated ego an even bigger puff. It used to be a core part of my strategy for getting clients on board. We both had something on each other. I could lose him his job, he could lose me my job. I used to come back from like an all-night bender, go straight into the office, and I would have to go on the mic in front of 200 people on the trading floor. One of the very first major presentations I ever did. I was doing it, and suddenly everyone started giggling, and I was thinking, what the is going on here? And suddenly I saw this blood hit onto my white shirt. And I was like, oh my God. And I've got a massive coke-related nostril bleed.
That sounds like a little bit of hyperbole, but, and frankly, if that were true, he'd be easily recognizable, I would imagine, because you gave that speech in front of a lot of people, and it's probably very memorable for them. So I question the validity of that story. But yeah, cocaine use and any type of thing that really speeds your system up is pretty common. I prefer caffeine, as you guys know, and I don't drink or do drugs, but I can tell you that I have seen a lot of it in the people that I've been around in and around that space, particularly in New York City. If you're going to a dinner with clients and you're going to be drinking the dinner, and then you have to get back home and do some work on your laptop, or you go back to the office, a lot of the junior analysts will do that. They'll go back to the office, they'll work super, super late, or they'll go to a team building event and then go back to the office and work some more. And they go home and sleep. They wake up, maybe 3 hours of sleep. They get back in the office by 6, 7, and it is a bit of a competition thing and a bravado thing. Who's there and putting in the hours. Very similar on the West Coast how the mortgage industry works in that regard. But the East Coast is the investment banking stock market space. So that being said, cocaine use and drugs that'll hype you up are very common in that space as a result of it.
All over my crisp white shirt. It's the perfect job for a psychopath. If you look at what psychopaths are, and I'm not talking about Hannibal Lecter.
I would say sociopath, not really psychopath, but yeah, you will see a lot of people who fit that generalized description in the business and the mortgage business too.
I'm talking about actual, normal, everyday psychopaths. They are manipulative. They are often charming. They hate jobs that require serious qualifications. They are people who don't show remorse or have empathy. For example, if a company announces that it's going to lose 1,000 jobs, you might feel that's a bit of a shame. But actually, in the city, we would absolutely celebrate and reward that company.
And they would say celebrate it and reward it and talk about it in the context of how that is going to help the stock price and it's going to help the shareholders. And they try to reverse engineer how they're really an advocate for the shareholder and they're returning the shareholders value. There are a couple of different ways of doing this. The Carl Icahn way, the activist investor way, where they come in, they try to streamline a company, and they're very, very aggressive, which sometimes results in middle management being wiped out, but the employees still being there. You know, I got more respect for that position. I also am a big fan, admittedly, of Carl Icahn. But the private equity variant is much more cannibalistic and much more vicious in a lot of ways. In the investment banking space, we'll put that together and pitch that. And what's not uncommon is you have investment bankers on both sides of a deal. And because you have investment bankers on both sides of a deal, they all have, everybody got their own independent counsel. The investment bankers have their counsel they're working with for the institution that's selling and one for the one that's selling, and all sorts of opinion letters flying around. But it is not uncommon for these people to have very open conversations with senior leadership about eviscerating companies they're going to buy prior to buying them, and not telling the company the totality of what they're planning to do with the company they're buying as part of this mergers and acquisitions activity they're doing. Because efficiencies, right, letting employees go, are generally the highest cost for many, many companies out there that can be abandoned in part when you merge companies together. One person takes on more work from the other company, and then one job is eliminated, and so on and so forth as you go down the line. I'm not saying I'm an advocate for it, but that is a known byproduct that he's talking about.
Because that company is going to be more efficient and it's going to make greater profits. It's an industry that rewards psychopaths.
It does.
And it's an industry that psychopaths thrive in.
Yes. Again, sociopaths more than psychopaths in my mind. And what I will say is he is absolutely dead on accurate that it does reward that type of behavior. If you can put aside your morality, and I've met a lot of people in this space who are good people, but they've justified, right? They justify this is just business. I have always taken the tack that it's not just business, right? If you have ever founded a company, I'm not talking working for a company and senior leadership in it. That's different. If you have founded a company, you've built it from zero to something, whether you've been part of the team that did it or the guy or the girl who did it, whatever, right? You have a different connection. You've seen employees grow. You've seen them get homes. You've seen them build families. You've seen them have children. And, you know, because of that, you feel responsible for their overall stability, right? Our job as employers, as people who have companies, is to give people that stability and to return to them the work they give to us in a way that improves the quality of their life over time. Unfortunately, a lot of companies lose sight of that. And if you're senior leadership in the company and you're, you know, working in this space, you say, this is the best thing for everybody else. And oh, by the way, it benefits me. What I always love to unpack is how senior leadership is being compensated as a result of M&A, because generally speaking, there's a real huge element of self-serving bullshit which goes into that. And you'll find a lot of self-dealing buried in the public filings, the Qs and the Ks. And it really, it's seething.
Insider trading happens all the time.
All the time.
Because people in the city aren't satisfied just with their six-figure salaries and their six-figure bonuses.
Yeah.
They want to get even more money. For example, during the financial crisis, there used to be rumors spread that this company is going bust, or this bank is about to have to ask the government for some money. And by doing that, these hedge funds were exacerbating the financial crisis.
And keep in mind, some of these hedge funds are so cryptic on the way they work internally that even if somebody wanted to talk to the outside, you would be, just banned from the industry, so you wouldn't be able to do it. But hedge funds, quant funds, private equity, venture capital, they're very, very laced with secrecy, and it's this internal crew, and there's this culture of we are who we are, and we're all together, and you buy into the corporate dogma, and then you don't talk about it. So a lot of this stuff is rampant in this space. There's regulators, there's bankers, there's attorneys, there's, accountants and auditors, third-party companies that are all coming in, looking at the due diligence on some of these trades and some of the things that are happening, whether you're doing a capital raise or you're selling your company or one form or another of some type of M&A activity. It's impossible to keep these things secret, so you do see a lot of insider trading, which anecdotally was the pitch by Polymarket's CEO of why he actually liked insider trading, as he felt that that was an open kind of nod without disclosing who they were, that was insider trading of things that are likely looming on the horizon. I don't know how you solve this problem because there's just too many humans in the element to ignore it, but it happens all the time.
Making it worse and worse and worse. But they didn't give a because they were making a buck themselves, and they never got found out because they...
And because they're sociopaths and, in his words, psychopaths. The other interesting thing about this, which is really fascinating to kind of digest and take down, is that not only do they not care, but they look at it as, I'm using my information and superior intellect to do these things. But if you did it over there, you are illegal and you should be put in jail. So it's the do as I say, not as I do context. I'm an upstanding citizen who runs this big company. So me insider trading is different than you insider trading because I'm doing it off of my intelligence. Or the more likely scenario, and you see this all the time between very successful individuals, is, and I have a money manager too, so I'm in the same position. But you see this all the time. Oh, you know what? Hey, my money manager made that trade. I didn't make it. You should be prohibited from making the trade, period. And your money manager should be aware of the industries and sectors that you cannot invest in because of your self-dealing risk to insider trading. But they don't look at it that way because I'm a good person. I would never do anything wrong, but you over there, you're a convict.
Could always claim they'd heard it from someone else first. So it's one of those crimes you never get found out for. The thing is about insider trading is people think it's like this victimless crime, but actually what it means is that a hedge fund, as it usually is, has bought some shares off Grand's pension fund, and that Grand's pension fund has unwittingly sold it to them, not realizing the share price is about to rocket when it gets taken over. So in fact, it's not a victimless crime. They're stealing directly off your granny. It's really simple. You just got a bunch of really...
Anecdotally, I would also point out that I think that sector, the mutual funds, ETFs, and like with Nasdaq, the Nasdaq has now taken SpaceX and dropped it in there. And now you've got this exposure that we all have to SpaceX, despite all this rhetoric of should I buy, should I not buy? It's got the total addressable market that's so high, they're never going to get all of it, and they're not profitable, and they're going to put stuff in space. I'd rather bet on space than on Bitcoin, and blah, 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 blah. We're all exposed. Okay, it's in the Nasdaq. Okay, it's in the funds. You're exposed. You have SpaceX, whether you like it or not. That's true. It's no different than what he's saying here. It's just now you got exposure to this bubble, whether you like it or not. So all this rhetoric and back and forth bullshit doesn't matter. Doesn't matter.
Clever, greedy, ruthless people together, and the rewards are massive, and the risks of getting caught are negligible. So they are going to do everything in their power via insider trading, spreading false rumors, market manipulation, anything. They'll just game the system to make a fast buck. And unless they really sort out regulation, it will always be the case.
And they're not going to.
I was playing for the team that was on the side of corporations that were raping this planet. And I was on the side of corporations who didn't give a shit about their workforce, but just gave a shit about their quarterly earnings figures.
So I'm going to stop right there on one element. As a guy who was an executive at a publicly traded company, I can tell you that you are not paid to give a shit about people quite the way that he's articulating. You should care about your employees. But, okay, and I do. I loved every single one of them. I still love them. I still keep in contact with most of them, and they're always welcome to call me. Most of you, if you watch this, have my mobile number, and I encourage you to use it. That being said, the problem with corporate America is if you're public, you have to improve your earnings quarter after quarter after quarter. You have to give guidance, not really forward guidance per se, but guidance on some level. You have to have quarter earnings call. You put out your quarterly statements. This creates a pressure every single quarter to perform better. You may not like AI, but you have a fiduciary responsibility to your shareholders to investigate it to see if it's economically viable to deploy AI and save money on FTE, full-time employees. Because you've got a fiduciary responsibility to return the highest and best possible outcome to the shareholder. That's your job. And that job is agnostic to your feelings. So in a lot of ways, the corporate structure perpetuates this problem. Morality is not built into the system. It used to be that companies would be forced to give back on some level. It's why the Rothschilds, the Vanderbilts, all these museums, everything else. It wasn't because they were charitables, they were giving back. And what their trade-off was for doing that was their taxes were taxed after expenses, unlike the rest of us who were taxed before we even get our wages from the employers. So the W-2 wage earners, I should say. So yeah, there is a bit of a giving back element that's missing here, and we've taken this corporate veil and we've treated it like it's a person by the masses, and we're upset at companies. But the law doesn't require it to act like a person and have that level of dignity and respect. You've got to put that in writing, and we don't. And because of that, companies are taking more and more off the table. Less 401ks, way less pensions than we ever had before, and way less benefits for a lot of the employees. And as a result of this, employees feel like they've been abandoned. So to his credit, yeah, it's true, but it's because the system is wrong for multiple reasons, not just because investment bankers are evil.
Kind of gets to you, especially if you have the kind of upbringing I had, which was fairly left-wing, religious, and I was a kind of a hippie as well. You know, I used to tell young kids what a terrible job banking was. And then when I described it, strippers, £1,000 meals, cocaine, bonuses of £500,000-600,000, they were like, tell me how I get this job. It has changed. It's more about being a serious guy with 2 maths PhDs. They are still earning a lot of money, but not as much. Nowadays, there's limits on how big your bonus can be. It can only be a maximum of twice your salary, whereas back in my day, you'd get 6 times your salary.
That is not true. It's true maybe where he's at, but that is not true in the U.S., not true in New York. 7-figure, 8-figure bonuses are not uncommon. I've seen them, so that's real.
Drop of a hat. It's no longer quite the playground for
it really is.
lads having a ball anymore. And thank for that, frankly, because...
As a matter of fact, it is especially for those at the top.
It's not right the way we used to behave.
It's still not right. By the way, that jacket is
I think on my deathbed, that particular phase in my life, I will not be very proud of. I sold my soul to the devil, basically. But I did get a good price for it.
Wow. I look forward to seeing the rest of that, although I don't know there's more that he can really add. So, yeah, I mean, a little hyperbole there, but nothing that I thought was, crazy. But, yeah. Investment banking, man. We should do a full episode on that at some point in time just to really talk about it in more detail. But thank you guys for tuning in. I appreciate it. It was a bit longer show than I normally do, but I thought that was kind of cool to share, and it was a good day in the market. So we're leaving you with, let's see here, a bit of no clear signal mixed day, so nothing really changed there. So, okay, so we're back where we started. Pretty mellow day, and everything works out. Until next time, I'll see you guys on Wednesday. We'll have some data prints coming up between now and then. I didn't cover the calendar because nothing really sexy and exciting coming up, but we do have an FOMC meeting to talk about it not too distant from now. Thank you. Appreciate you tuning in. Okay, bye now, everybody.